Howdy, Jacob here. Today we're going to do a more in-depth analysis on AMN Healthcare Services in the healthcare provider and services industry. So I want to go over the numbers to remind everybody about the company. As when I first did the analysis, it's now dropped to 23% above the price to where we think we're going to get a return. So I read through some quarterly reports, the most recent 10Q and 10K, and pulled out some numbers or pulled out some um, items from the report. So let's go over the numbers to remind ourselves about the business. So huge increase in revenue over the last 10 years from 1 billion to 3.8 billion, but we are seeing a big decline this last year. They are still well above their pre-COVID levels. Gross margin increased, operating margin increase, good return on invested capital, low 10 to 15% range. Cash on hand is only $33 million with no short-term debt, but 1.3 billion long-term debt with cash flow, very solid cash flow production, use of cash, very heavy on the acquisition side, a little bit of share repurchases, and a good amount of debt issuance. So let's go over some of the notes that I wrote down after reading the quarterly reports in 10Q and 10K. So their main focus of capital allocation a year ago was share repurchases, followed by reinvestment and acquisition. However, they haven't repurchased shares since August of 2023. So this was in their Q4 2020, Q4 22 or Q1 23 report, and they said that we are going to be focusing on share repurchases, which they ended up buying back a lot of shares in Q1, so it does make sense, and then a little bit of reinvestment and acquisition when it makes sense. However, right now, we haven't seen repurchasing of shares since August of last year. In each of the last 5 quarters, there has been revenue and profit declines, both decreasing at least 20% year over year. So pretty hefty declines on the top and bottom line. So I said I do appreciate the honesty about weaker demand and increase in competition, but I would like less vague course of action going forward. So just a little quote from the report. AMN continues to innovate and modify our solutions to partner with health systems as they make transformational changes that include new labor models. This includes broadening our market reach to help more clients develop and implement cost-effective, high-quality workforce solutions to enable them to meet the growth in healthcare demand. And then the CEO continued, we continue to proactively manage expenses and capital spending in the near term amidst lower travel nurse demand while maintaining progress on key long-term objectives. So really, to me, that's just a very vague statement. I think they're trying to just say what we want to hear, the shareholder wants to hear, which is fine, but it's not great. So that's just coming in. Again, every comment I say is not necessarily good, bad, ugly, yes, no, maybe so. It's just the way it is. So take everything with a grain of salt and take everything as a piece to create a puzzle of how you want to define and understand the business that you're looking at. So to me, that's the board CEO is just part of the whole business, and so based on their comments, I'm just a little hesitant on how exactly they're gonna, yeah, there's a decrease in demand of workers, but what are you gonna do about it, type of thing. Substantially, pretty much all their revenue is generated in the U.S. Demand for services is dependent on health of hospitals and their healthcare industry. So again, they really are a lot of their well, I guess let me go to the next point. So their 2023 revenue declined 28% year over year from 5.2 billion 22 to 3.8 billion 2023. Nursing and allied solutions make up 69% of revenue, which had a 34% decline. Physician and leadership make up 18%, just declined 4% year over year. Technology and workforce solutions make up 13% and had a 12% decline in revenue. So basically, they have travel nurses that they go through, make sure that they're vetted and everything, have all their credentials, and then assign them to hospitals that they're connected with. And there's just been a very large decline in travel nurses, which if anyone knows anyone in the nursing field, I know my wife has been a nurse for a while now, and there was a humongous increase of demand for once COVID hit, as COVID was taking over floors, and then that decreased the number of employees that were working on that specific floor. So there was just huge demands all over the place, and we are seeing a bit of decline now, which we can see here, as well as my wife saying that there's been way less demand for travel nurses. She hasn't seen as many. The contracts aren't as nice from what she's heard of from the few that she's talked to, and everything. So, um, but again, they jumped so much from COVID, like 66% year over year and 31% year over year. And that really was a little bit of acquisition, but mostly just the demand for their services. The biggest hit to margins was their selling general and admin expenses. So 2.1% increase there. Their acquisitions increased 1.6%, and depreciation, interest expense up 0.7%, partially offset by tax expense due to making less money. So this led to net income margin to decline almost 3%. So that's 3% is 8% down to 5%. So that's a almost 40% decline. That's pretty hefty. They have 474 million debt due in 2027, 313 million due in 2029, and then a revolving line of credit of about $400 million. Their capital allocation of the last 3 years, about 37% to acquisitions, 91% to share repurchases. You can see that that adds up to over 100%, and that's due to issuing about 42% of debt. So when they were doing best, they issued a lot of debt to repurchase shares. We're about to look at what price that they paid for these shares. So currently, the price of the company's stock is $53 a share, which, again, just because it's lower doesn't mean it wasn't a good investment. We're about to see whether they bought it at the right price, but we see that there was a hefty amount of share repurchases in Q1 of 22 and Q2 of 22, and then again in 22 Q4, 23 Q1, 23 Q2. And like I said, they haven't repurchased shares since August. And so as the shares have declined, they haven't repurchased any. So they made a pretty large investment up here of about, what is that? Maybe 170, 160 million dollars. And now that investment is worth half that because the company's stock price has fallen in half. Again, it's not to say that in the short term in the short term it looks like a bad investment, but if the company grows very substantially and is able to outsurpass that, then it could be a good investment. But I don't like that they're not repurchasing shares as it's gone down. I'm a little hesitant about that. But also they do have a lot of debt now, so they're going to have to focus a lot of more of their capital allocation on debt reduction and less on share repurchases. Last thing I want to say is long-term debt is just under 5 years their most recent year free cash flow. If you remove the roughly 400 million in revolving credit, it's about 3 years. And we do see that their enterprise value is quite a bit higher than their market cap. So if I input my new assumptions here, basically decline the revenue change because I think there could be 1 to 2, 3 more years maybe of revenue dampening or at least steady flow, and then it'll get back to that 3, 4, 5, 6% revenue growth. It dampened the margins because their margins have been hit by selling general and admin as the biggest one. You can't just if you remove that or you lessen that, that's going to lower your revenue at the top line usually. I reduced their share change to just 1% as they haven't purchased anything since August. So I think if over a 7-year period, I do think they'll repurchase at least 1% a year. But I think that now they're going to have to really be focusing on debt reduction and some of those other things that aren't necessarily the most advantageous for the business. And then I made their PE and price free cash flow closer to a price to enterprise value. So even at the end of 7 years, they might have 3, 4, 5% growth ahead of them, I think, for the next decade or so per year. Their enterprise value is still going to be quite a bit higher than market cap, so I feel comfortable with that. And this is saying it needs to fall in half. So we're not quite there anymore. once we do a farther research, and that's why we do a deeper dive on companies. So I hope you enjoy the video. Have a great rest of your day. Thank you.